Good evening, ladies and gentlemen. Thank you also to AJ Bell for organising this. It's wonderful to be able to talk in person in front of so many people. So I'm going to talk about City of London Investment Trust, where I've been manager for the last 31 years. And I'll talk a bit of background about the fund, but also how it's currently positioned and how I'm seeing the markets. So our objective is really sort of twofold: to grow income and capital over the long term. But also we have a particular emphasis on income, and we think income is very important for people. People need dividends to pay their bills, and also it is a very important component of the long-term return from equities. It's often people think equities is just about capital gains. Actually, long-term studies show that a very important part of the return is from income. As an investment trust, we have an independent board of directors. That's one of the great strengths of investment trusts, one of their great big advantages. And they're there to look after you, the shareholders. And we have 8 board meetings a year where they sort of grill me, and I learn a lot from them. And the current chairman is Laurie Magnus. He's been chairman for the last 2 years. He has a long career in advising companies and corporate finance. You may recognise his name because in December he was appointed as ethics advisor to the Prime Minister. And he's recently had to advise on the chairman of the Conservative Party, so he's been quite busy. City of London's assets are just around just short of £2 billion, and we've been popular with investors in recent years. We've issued a lot of new shares, all at a premium to net asset value of around 2%, and so at that level we are enhancing NAV by issuing shares. But when we did slip to a discount in September 2020 of 2%, we were very keen to buy in shares, which we did. In terms of the management, as I said, I've been manager since 1991, and my deputy is David Smith. He and I have worked together for around 10 years, and he became officially deputy in July 2021. Investment management fees very low on the fund at 0.325. That's the benefit of that independent board of directors, and we've got the lowest ongoing charge ratio in our sector. So I work in the global equity income team at Janus Henderson. And we manage some £13 billion between us. Obviously, David's the key person I work with, but I've got, it's a really great team of colleagues. I'm actually the oldest person in the team. I'm 61, but I'm in good company because James Henderson, who some of you will know, is only 2 weeks younger than me, even though he looks about 10 years younger. So I'm in good company with him. And but we've got a range of colleagues, different age groups, different perspectives. And and it's great. We're now back in the office as well, and that is even though Zoom and Teams are a miracle, it is much better to be in the office with your colleagues. So I'll talk a bit about the philosophy of how I manage City of London within our team. It is valuation driven. I believe that the share price valuation will determine the ultimate return, and I look at a range of factors, but we do start with dividend yields. And the key for us is being in stocks that are paying a decent dividend and growing their dividend and investing enough for the future. So we want to avoid the so-called high yield value traps. These are the companies that are over distributing on their dividends and end up sort of disappointing and having to cut their dividends. So I would say the strength of the valuation approach is that you tend to avoid the high flying stocks, which are incredibly expensive, which disappoint and crash back down to earth. The potential weakness is the so-called value trap. And so we're very conscious of being in companies that are really investing enough for the future. And the valuation style is kind of aligned with kind of conservative stance. It's a pretty well diversified portfolio, and we like companies, a bit like Russ was talking about, with strong balance sheets, good cash flow. We don't like highly indebted companies. If you owe a lot of money, then in a downturn, you're going to be thinking about your bank manager first, and not about paying a dividend. So those are the companies that end up cutting their dividends. So particularly companies with a mixture of, as Ross was saying, operational and financial gearing. So we're looking really as much, looking as carefully at the downside risks as well as the upside potential. I won't go through. I've got a chart there of my process, but one thing that's come up a lot in recent years is ESG, which is looking at the environmental, social and governance factors and shares. And we do analyse that, but we don't exclude any shares. And there have been a lot of opportunities. One company that sadly it's been excluded a lot by some of these funds, so-called responsible funds, is defence contractors. Well, we took advantage and bought a big holding in BAE Systems, and sadly, it's a great British company. It's our biggest defence company. It's also the sixth biggest defence contractor in the United States, and it took the war in Ukraine for the people to wake up to what a good company it was, and it's been one of our best performers over the last year. So actually, some of the way we look at it, it's kind of throwing up opportunities for us, the ESG thing, but it is important to analyse and understand what the risks and opportunities are from ESG factors. Oh, sorry. So just a bit about performance. That chart shows the performance since I became manager 31 years ago, and you can see we're comfortably ahead of the FTSE All-Share, which is the main benchmark for the UK and our benchmark over that long period. We haven't outperformed in every market, certainly in markets which are sort of led by growth stocks. We make you good gains, but we don't tend to outperform in those markets, but we do better in difficult years. And a case in point was last year, where we were comfortably ahead of the market and made solid returns, positive returns for investors, as you can see. And we are ahead of the index over 1, 3, 5 and 10 years and the competition, the average of the competition. So now to look at the revenue side of the equation. And we are distinguished by having the longest track record of any investment trust for annual dividend increase. In fact, I don't know of another UK quoted company. We go back 56 years of annual dividend increases. And I think a lot of you will know this, but it's worth just saying again, but a key factor, you've got to have a core of consistent companies in the portfolio, which we do aim to have. But a key factor is the investment trust structure. And basically, investment trusts are allowed to hold back up to 15% of their earnings in any one year. And so in the good years, we do retain a bit of earnings. And you can see this in the table, which is on the slide. And you can see that this goes back to the last 5 years. And certainly, you start the period, it shows the earnings per share and the dividend per share, and also the payout ratios, the amount we're paying out. And you can see in the years, we're June year end by the way, that's why it's each year ends in June, financial year end. And you can see in the periods 2018, 2019, we put money back into reserves. We sort of paid out around 94, 95%. Those periods have put an extra 5% back into our revenue reserve. And then, of course, the pandemic came. Some FTSE 100 dividends were down by 36%. Outside the FTSE 100, it's even worse than that. And so we then drew down on that reserve, which we built up over the years, and we paid out 21% from the reserve, but carried on growing our dividend. The next year, to June 21, we still needed our revenue reserve, but it was a better situation. We paid out around 11%. And then last year, which ended in June 22, we were back to putting money back into the reserve again and continuing to grow our dividends. So I have to say that if it had been an open-ended fund, we would not have been able to grow our dividend during this period. It's the investment trust structure where you can save money in the good years and then draw down on that in the difficult years. That's allowed us to achieve that 56-year record, which we're very keen to continue with. And that's the long record, and it shows you partly the compounding effect. I mean, a dividend increase in any one year may not seem massive, but it does compound massively over time. And I mean, last year to June 22, we grew our dividend by 2.5%, which obviously is below inflation. And the board have said that they're looking to grow the inflation above inflation over the whole economic cycle. Obviously, with inflation having risen so dramatically, it was difficult to achieve last year. But over the last 10 years, our dividend is up 41% as compared to CPI inflation, 26%. So I'll now move on to talk a bit about the market and how Citi's performed and how it's positioned. So this chart just shows you the performance of the British stock market over the last 10 years. And the top line shows you the world index excluding the UK. And the bottom line shows you the UK. And you can see it's quite a dramatic underperformance. Got improved slightly recently. I'll talk about that. But I think it's partly to do with the composition of the indices. I mean, the world index return's been really driven by the American stock market, the big technology stocks, which have done dramatically well until about a year ago, when they've faltered somewhat since then. And we don't have really the same equivalent in our market of an Apple or a Microsoft. So I think that is one factor. I have to say, I think if you look at the chart, the lines begin to sort of depart around in 2016. That was the year of the Brexit referendum, and whatever we thought about Brexit in our country, I think global investors took a bit of a dim view of it, I'm afraid, and I think that's affected the pricing of UK shares. But the lines are beginning to sort of get close. It's been a much better year for the UK. I mean, our index conversation around it looks a bit old-fashioned to some people. Someone, a leading growth stock manager a couple of years ago, described it, the FTSE 100 as a 19th century index. Well, last year we discovered that actually the world still needs oil. The world still runs on oil. Banks can make big profits. Miners can pay fabulous dividends. So the UK sort of slightly came back into its own. And the other factor is UK shares are cheap. I mean, even if you strip out the difference in the indices, we estimate that UK shares on a like-for-like basis, you compare, say, Exxon with BP or Shell, UK shares are like some 20% cheaper than overseas shares. And I think the evidence for this is just a sheer number of takeovers you've had of UK companies. I mean, it's very sad in many respects, but we've been a rash of takeovers from foreign companies and also private equity firms. And in our City of London portfolio, over the last year or so, we've had Morrison's, which was taken over by a US private equity group. We've had Daily Mail in General, where Lord Rothermere took it private. And we've also had Brewin Dolphin, the private client wealth manager, which has been recently bought by Royal Bank of Canada. Just three, there are plenty of other shares. And I think that's just the hard evidence of how cheap the UK market is. And it's just pleasing that those lines, which were a chasm kind of 18 months ago, the UK's had a much better year. As Ross was saying in his presentation, the FTSE's been the best performing of the major markets over the last 12 months. So it's good to see the gap closing, but it's still, in my opinion, it's still cheap, the UK, relative to other major equity markets. So I'll talk a bit about the market valuation and the sort of economic outlook. I mean, obviously, inflation has now highest it's been for 40 years. I think the central banks were too accommodative for too long. I mean, the dramatic cuts in interest rates the start of the pandemic were correct, and some of the quantitative easing, but it went on for far too long. They've let the inflation genie out of the bottle, and I think it's going to be quite hard to bring down. I mean, it's peaking at the moment, and because of the effect of the oil price comparisons of a year ago coming out of the annual figure, it will decline. So it's peaked at 10.5%. I mean, Prime Minister has said one of his aim is to halve inflation. Well, that brings it down to around 5%, but actually the government's official target is 2%, and I think it's going to be a lot harder to get that down to that 2% because you're getting the second-order effects. You're getting massive wage unrest, and you're seeing it with strikes, particularly in the public sector, or mainly almost wholly in the public sector. So it's quite hard. I can see inflation getting back to the 4 to 5% range, but I think it's going to be a lot harder for inflation to fall beneath that. And I think another aspect of, caution is really the monetary tightening that's taking place. I mean, the central banks have, we may be getting closer to the peak of interest rate increases, but they've bought in recent years a lot of government bonds being bought by the central banks. The Bank of England owns around a third of the gilt market, and as they seek to offload those gilts, I think it's going to put pressure on financial assets in general. So I'm sort of a bit cautious overall on the macro. I mean, certainly there are some positive features. I mean, the fact that COVID is over, in particular, China finally has ended its zero COVID policy, that would be very good for global growth. But overall, I mean, one of the things investors can do is they can use a bit of borrowing to be in the market, and we have a kind of fairly defensive portfolio. So our gearing at the moment is only about 7%, which is the lower end of the range. But what we have done in recent years is we've issued some very cheaply rated long-term debt. So we've issued a £50 million note paying a 2.94% interest rate right out to 2049, and an even cheaper one, a 2.67% note. So that's an annual interest rate, 2.67, going out to 2046. That's a £30 million private note. So that is something Investor Trust can do, and it means we've locked in ultra cheap interest rates for our investors, for the next quarter of a century. And we're now borrowing more cheaply than the government does. I mean, the long gilt is now around 3.5%. So it was a big opportunity during the sort of somewhat artificial fixed interest market in the last couple of years to take out some long-term borrowings. I've got a couple of charts there of two very familiar standard valuation measures of the UK market. On the price-earnings ratio, we're below the long-term average. But in terms of yields, it has changed a bit. Obviously, equities were yielding a lot more than base rates and fixed interest. I mean, base rates now up to 4%. The equity market's yielding about 3.5%, which is similar to where the 10-year and 30-year gilt. But of course, equities you do have the prospect of dividend growth from equities, which you don't get from fixed interest, and that's particularly important in an inflation environment. So I won't go into a huge amount of detail about the portfolio characteristics, but we are predominantly in the large cap end of the stock market in the FTSE 100. We can invest up to 20% in overseas equities, so we have made some really add a lot of value in that area as well. We believe in a reasonably diversified portfolio. Our biggest group at the moment is financials, and actually higher interest rates and higher bond yields are quite good for a lot of financials. It's actually better for the banks. It's better for many insurance companies. So, and we see that I think financial is something we in the UK do very well actually, and so we see a lot of value in that sector. Our biggest holding is HSBC. The other big block is so-called consumer staples, of which BA Tobacco's the biggest holding. We've also got big holdings in Unilever, Imperial Brands, and Diageo in that area, and Tesco's. And then we've also got exposure to industrials. I talked about BA Systems. Oil, we've got Shell, BP, and also healthcare, with AstraZeneca being our biggest holding in that. But we believe in a reasonably diversified approach. This chart just shows you, but if you drill down into the underlying sales of the companies we invest in, our investee companies, some 2/3 are from overseas, even though we're over 80% UK listed company. It shows you how international the UK stock market is. So you get really the advantage of the kind of the discounted UK share prices, but get a lot of global exposure at the same time. Just a brief look at the top 10. You see there are 4 consumer staples stocks in that top 10. Now, Shell, after its recent strong performance, is actually just ahead of BA Tobacco now as the biggest holding in the company. It has room for some lower yielding stocks in the top 10, such as Diageo and Relics and AstraZeneca. And then the next 10 down, you see our biggest financial, which is HSBC, a couple of utilities, National Grid and SSE. And SSE in particular is very well placed to benefit from the energy transition. It's Britain's biggest generator of electricity from renewables, both hydroelectric, and it's our biggest wind farm producer, and got some really good growth prospects there. So to finish off, it's 56 years of annual dividend increases, which is the longest record of any investment trust. I mentioned we've got a core portfolio of consistent companies, but also it's undoubtedly been the investment trust structure that's enabled us to achieve that record. Ongoing charge ratio at 0.37%, which is very low for an active managed fund, and the lowest in our AIC UK equity income sector, and low when you'll find in the open-ended sector. And long-term outperformance of the FTSE All-Share Index for a conservative investment style. Thank you very much.